If you're watching the markets right now, I mean, you are just seeing capital flood toward artificial intelligence
Right.
well, at a completely unprecedented rate. And that raises two massive questions, right? At the same time, is it too late to get in? And, what are the truly successful investors, the ones who've seen multiple bubbles and booms? What are they doing right now? Today, we've got a really specific stack of materials that tries to answer those questions. We're looking directly at the quarterly moves of one of the all-time great traders, Stanley Druckenmiller. He runs the Duquesne family office, and his recent moves are sending some pretty sophisticated signals about where the next phase of AI money will be made. Okay, let's unpack this. Our premise here is simple. You should never, ever blindly copy a billionaire's portfolio.
No, absolutely not.
Their risk tolerance, their timeline, it's almost certainly different from yours. But when an expert manager who's overseeing billions of dollars makes a sudden, decisive pivot.
You have to understand the why.
Exactly, the why behind that shift. And the mechanism we're tracking is the 13F filing. These are the mandatory reports that managers overseeing, over $100 million?
That's right, $100 million, they have to file them with the SEC.
And it gives us this critical, though delayed, glimpse into what they're actually holding. So we're focusing on Druckenmiller. His 13F securities alone total around $4 billion. And his latest filings for Q3 2025, they suggest a really profound, renewed focus on the platforms powering AI's future. So our mission today is to dig into his incredible track record, analyze the, frankly, shock of his recent exits, and then really examine the 3 new platform bets he made. And we'll use all of that to evaluate the $4 trillion question. Is there still significant growth left in AI stocks in 2026, or is the party over?
It's impossible to analyze the portfolio moves without first analyzing the man.
You have to know who you're dealing with.
Exactly. We are talking about Stanley Druckenmiller. If we skip straight to the stocks, we'd miss the pedigree, and that pedigree is the entire foundation for trusting this analysis. Druckenmiller operated Duquesne Capital Management for 3 full decades.
30 years.
30 years, he was navigating every major market swing, from the dot-com bubble to the global financial crisis. And what's truly remarkable, and the source material really emphasizes this, is that across those 3 decades, he recorded no money-losing years.
That statistic is genuinely baffling. I mean, for anyone who follows the market, to not have a single down year over 30 years, that's not luck. That speaks to an iron discipline.
It absolutely does. And to compound that, he delivered an astounding annual average return of 30% over that time.
30%.
He stepped back from managing other people's money about 15 years ago, but he's still managing his own wealth through his family office today. So when we see a position shift from an investor with that track record who has proven he can spot long-term trends and manage risk, it's not just another trade. It becomes a major signal about where we are in the technology adoption cycle. So the lesson for you, the listener, is to treat his moves as a highly validated hypothesis you can use to structure your own research.
Right. It's not about copying the trade. It's about understanding the thesis. And that thesis gets really fascinating when we look at what he recently got rid of. So Section 2 is all about the shockers. Despite being very active in AI for years, he made big news by exiting 2 of the sector's biggest darlings.
The biggest.
According to the sources we reviewed, he exited Nvidia late in 2024, and then followed that up by completely selling out of Palantir Technologies in early 2025. Now these were, and I mean they still are, powerhouses of the AI boom. They had soared, so why? Why sell out of the 2 companies that arguably dominated the first couple of years of this whole AI spending spree?
Well, it's the ultimate display of patience and risk management.
Discipline again.
All about discipline. The material suggests this was a classic move. He was taking profits when the valuation multiples had just sprinted way ahead of the near-term earnings potential. He's not saying the AI story is over, not at all. He's saying the valuation for those specific names at that specific moment was just pricing in too much optimism too quickly. He's swapping what he sees as near-term froth for better perceived value somewhere else. I mean, that's what a disciplined manager does. You rotate capital.
That makes perfect sense. But if he was selling the high flyers, did he just abandon AI infrastructure completely?
Yeah.
Or did he keep some kind of anchor in the sector, to show he's still confident long term?
He absolutely maintained an anchor, and what that anchor is very telling. The lone top AI holding that he kept high in his portfolio is Taiwan's Semiconductor Manufacturing, TSMC.
TSMC, the world's leading chip fabricator.
Precisely. Even after those massive, high-profile exits, TSMC is still among his top 5 positions overall. It's holding the number 4 spot with a hefty 5.2% weight in the portfolio. And this creates a really critical distinction for us to analyze. He sold the company known for designing the chips, Nvidia.
And the company applying the AI software, Palantir.
Right, but he kept the one company that physically manufactures the most advanced chips for the entire world.
So his core thesis seems to be that the foundational layer, the infrastructure that literally produces the capability, is safer and more essential than any single application.
It's the classic shovel seller in a gold rush.
Exactly.
That's a great way to frame it. TSMC benefits no matter who wins the design war, whether it's Nvidia or AMD or someone else. They own the most critical bottleneck in the entire AI supply chain. So keeping that position shows this unwavering confidence in the long-term secular demand for advanced silicon, even while other stocks cycle up and down.
That's a very clean, coherent strategy. Hold the foundation, adjust the more volatile layers on top. But now let's get to the aggressive buying. I mean, this signals his belief in what's coming next. He clearly hasn't gone defensive. He's repositioning. Here's where it gets really interesting. In the third quarter of last year, Q3 2025, Druckenmiller opened 3 very specific, very significant new positions.
And these aren't speculative small caps.
No, not at all. They are 3 of the largest, most entrenched tech platforms on the planet. Let's detail these new bets because they tell us everything about his long-term AI strategy. First up, Amazon, ticker AMZN. He bought a pretty sizable block, 437,070 shares. That gave it an initial portfolio weight of 2.3%. The second major position was Meta Platforms, Meta. He picked up 76,100 shares, which resulted in a 1.3% portfolio weight. Finally, rounding out this trio is Alphabet. That's both GOOGL and GOG. He bought 102,200 shares, establishing a 0.6% portfolio weight. Okay, so these 3, Amazon, Meta, Alphabet, are already trillion-dollar giants. My question is, how can the source material call them reasonably priced for AI growth, especially after you just sold Nvidia, citing high valuation? Does that seem like a contradiction?
That is the central question. It's a brilliant one. The term reasonably priced here has to be viewed relative to their potential and their established infrastructure. Nvidia's valuation was based almost purely on future AI chip sales. These 3 companies have enormous, profitable, non-AI businesses that act as these massive safety nets. Take Amazon. That's primarily a bet on AWS, on Amazon Web Services.
Right, the cloud.
Cloud infrastructure spending is the gasoline for AI development. Amazon isn't just selling chips, they're renting the virtual factory floor to basically every company building AI tools. Their position is essential, it's extremely profitable, and it makes their AI growth this powerful, almost guaranteed add-on to an existing cash flow machine.
So AWS is like his TSMC position. It captures infrastructure spending. But what about Meta? They've been spending so heavily on their Llama models and the metaverse. How do they fit in?
Meta is a bet on 2 things: data and deployment. They own the largest and most valuable real-time data sets in the world through Instagram and Facebook.
Which is critical for training.
Absolutely critical. But also, they're focused on internal efficiency and deploying applications. Llama, their open source model, dramatically reduces their own operating costs. And they have the deployment mechanism, billions of users who will be interacting with Meta's AI products every single day. That user base is their competitive moat for what comes next.
Okay, that leaves Alphabet. With Google Search and Gemini, they have maybe the most recognizable AI footprint, but the sources gave it the smallest weighting. What's the strategic niche for Alphabet?
Alphabet is the long-term play on, well, intelligence and ubiquity. They're investing at the deepest level in fundamental AI research. Gemini is a perfect example. And more importantly, they own the global search platform.
The main distribution channel for knowledge.
Exactly. The thesis here is that Google is fundamentally transforming search with AI, making it more of an active assistant than just a list of links. You combine that with Google Cloud, and they're positioned to capture value from consumers and from enterprise. They're the most diversified AI bet of the 3.
So to sum up the strategy, he sold the high-multiple, pure-play risk Nvidia, Palantir, and replaced them with 3 massive diversified platforms.
Amazon, Meta, Alphabet.
Each one capturing a different vector of the AI revolution. You've got infrastructure, data, and deployment, and intelligence, and ubiquity. That is a profound pivot.
It is. He's moving from betting on the tools of the AI boom to betting on the terrain where the boom will actually be monetized at scale. And that brings us perfectly to the biggest question. Why now? Why in late 2025 is this shift happening, and why should we expect returns in 2026? If we connect this to the bigger picture, The core argument for continued growth is that we are still in the very, very early stages of the AI growth story.
It feels like we've been talking about it for years, but you're saying it's still early.
Yes, the stocks have soared, but the actual widespread economic application of AI across global industries, that hasn't even really begun in a major way.
We've heard these terms, but let's slow down and really define them. What do we mean when we say we've been in the training phase and now we're about to enter the inferencing phase?
It's the crucial distinction. Think of it this way. The last few years, the phase where Nvidia soared, that was all about training.
Building the model.
Exactly. It's the expensive, upfront, capital-intensive work feeding enormous data sets to massive clusters of GPUs so the model learns. It's like building a high-performance race car in the shop. Inferencing, on the other hand, is the deployment phase. It's when the model is actively used by millions or billions of people to answer questions, power apps, automate systems. It's the race car being used on the track for daily competition. And globally, inferencing will use far more computing power than training ever will. That's where the real economic value is captured.
That makes the shift immediately clear. Training is centralized, done by a few huge tech firms. Inferencing is decentralized. It involves practically every company on Earth deploying these models.
Exactly. And the vast majority of companies in healthcare, manufacturing, telecom, finance, they haven't deployed these models in earnest yet. They haven't started inferencing at scale. That widespread application is the wave that companies like Amazon through AWS and Meta through their apps are perfectly positioned to monetize.
So that paints a picture of a massive, long runway, not a market peak. And the scale of infrastructure spending needed to power this, that leads to those staggering forecasts we saw.
It does. To support this global shift, the underlying infrastructure needs to expand exponentially. The source highlights the prediction from Nvidia's chief, Jensen Huang. He suggests that total AI infrastructure spending may eventually reach an incredible $4 trillion.
$4 trillion. That's a staggering number. It implies that current valuations are still low if that forecast is even remotely accurate.
It does, and the current demand trends from the tech companies we discussed, soaring demand for cloud compute, soaring internal AI spending, it all supports the idea that we're heading toward a period of multi-trillion-dollar expenditure on AI deployment.
So this really helps us understand Druckenmiller's move. He's swapping out of the companies that already captured that initial training wave.
And moving into the platforms that will capture the deployment and monetization of the next, much bigger inferencing wave.
That's the strategic takeaway.
And while it's impossible to predict when temporary market pauses or corrections might happen, the sources are very clear on that. The long-term positioning of platforms like Amazon, Meta, and Alphabet is incredibly strong as we move toward 2026. They are designed to capture that $4 trillion wave.
So, what does this all mean for you, the learner? Druckenmiller's strategic pivot provides a really sophisticated roadmap. He is confident enough in the long-term AI trend to hold his core TSMC position, but disciplined enough to trade out of frothy valuations. And he's pivoting into platforms that offer more diversified, reasonably priced exposure to the coming inferencing deployment phase. For the growth investor, the takeaway isn't just about valuation, it's about strategy. The pivot toward established platforms that own the deployment channels, AWS, Meta's data, Google Search, and Cloud. It suggests the smart money is betting on the monetization of AI being distributed widely through these giants, not just concentrated with the initial chip pioneers.
And that distribution ties back entirely to the concept of inferencing. We discussed that the shift from model training to massive model inferencing is a deployment phase that will transform every single industry. So here's a final thought for you to consider based directly on this material. The sources mentioned expansion into areas like robotics and telecom, among others. Given the need for widespread adoption for immediate efficiency gains, which of these key sectors, robotics, telecom, or maybe a totally different industry like healthcare, which one will be the very first to be truly and comprehensively transformed by this widespread deployment of inferencing? And more importantly, how might that early sectoral lead dictate where the initial flow of that predicted $4 trillion in infrastructure spending lands first? That's the research path that will define the next great investment opportunity.